business. So we want to start by thanking Think Duchess, Sarah Lee, Amanda Gomez, and Renee Richards. They've done an amazing job putting this program together. My name is Pam Miner from Hudson Valley Center for Innovation. Paul is with me today, and we also have with us Carol from Pursuit and Yuritsa she's going to tell you what her name of her business is when we get there. A clear title.
Absolutely clear.
Got it. Okay. So let me tell you quickly about Hudson Valley Center for Innovation. We are a nonprofit led by entrepreneurs and for entrepreneurs. We've brought our personal experiences and backgrounds, our networks, and we've successfully helped hundreds of small businesses at different stages of their business to start, grow, and commercialize their companies. So we look forward to working with you during this series and to helping you afterwards if the opportunity arises. Quick background on myself. I started my career 1,000 years ago. I've been helping small businesses basically my entire career. I started by helping businesses expand in the international arena. I moved back closer to home when I had my kids and started my own small business, again, as a consultant, working in a family business and also helping other small businesses to grow. I joined Hudson Valley Center for Innovation in 2020 and have done technical and business training to, as we said, hundreds of companies, helping them tackle their challenges and grow and flourish. So before we get started, just a couple of quick items. We are recording this session, so you'll have access to it afterwards. And it is an interactive event, so we'll look forward to hearing your questions. You can either raise your hand or post it in the chat. So with that, let me introduce you to Paul, my colleague Paul, and we look forward to an interesting session. So Paul.
Good morning. This session is near and dear to my heart because I started my career in banking and then moved over to the nonprofit lending side, working for a CDFI, both in Austin, Texas, and then in New York City. We'll get into what a CDFI is here in a bit with Carol and Pursuit. But after working in lending, I chose the entrepreneurial route, started an agency with 4 other people where we basically served entrepreneurs, getting them from 0 to 1. That looked like software development, branding, financial modeling, everything that an early stage company needs to really get off the ground. In that process, I met one of our founders who was starting a trucking employment agency, basically, and he wanted to apply technology to that. So I ended up joining up with him, going through an accelerator program, raising some money, and then getting that product into market and growing it to a few $1 million. They're still going. The company is called Fleeting. And ever since then, I've been basically on my own and with HVCI working to help small businesses and early stage startups either get off the ground or grow. And yeah, I think that today's session is going to be really interesting. We've got Carol O'Connell here from Pursuit and Yuritsa Ruiz from A Clear Title. They've worked together to get A Clear Title funding so that Yuritsa can grow her business. So we're going to lean into her story and then also talk about the process of securing a loan, what that looks like, what the loan does, for a business, both negatively, positively, just to kind of get all the facts from Yuritsa. So I guess with that, I'd love to turn it over to Carol to give her a chance to intro herself.
Fantastic. Thanks so much, Paul. So I have a similar career as Paul. I did start out in commercial banking for decades, but I'm thrilled now to be working for Pursuit in the nonprofit small business arena. So Pursuit is a community-focused lender to the small businesses. We started over 65 years ago, primarily as an SBA lender in New York State. But today, we're proud to say that we actually are lending in New York, New Jersey, Pennsylvania, Connecticut, and we're doing outreach in Chicago. And we offer, it's like a one-stop shop for transparent lending, over 15 different programs. And we cover businesses from startups all the way through to growth commercial real estate. So loans from $5,000 to $5 million. which is amazing. But Paul mentioned that I think the focus today would be to introduce the audience to what CDFIs do. That's community development financial institutions, but we call ourselves community lenders. We are certified by the U.S. Treasury, and we provide fair, transparent financing coupled with education. So I love both sides of the business. That's why I'm here to talk about it. And I'm excited to introduce to you one of my favorite clients, Yaritza, and she take it over, Yaritza.
Well, thank you, Carol. I appreciate this platform. I think this is really great for future business owners and current business owners. So to introduce myself, my name is Yaritza. I am a small business owner. My company is called Absolutely Clear Title Agency, and we are in the industry of real estate. I began my business in 2020 after being in the corporate world, learning a lot, started networking, realizing that I may have a little bit of an entrepreneurial bug and maybe can do this on my own. And then the shutdown happened and it was like, what am I going to do? So fast forward, I ended up incorporating it and starting it with the tools that I thought I knew. And fast forward a year later, business was growing organically. And once I had a full year of finances and sales, my accountant and my bookkeeper started noticing that I was using credit cards a lot. So when I started the business, we learned a lot about like net 30 accounts and how can you build your business credit so that you can rely on your business credit versus your personal income. And that self-education led me to obtaining a few credit cards that I said, okay, I can lean on these credit cards while I close. So in my industry, I can receive business and instantly have overhead, but I'm not making the money until these closings happen. So once we get to the table and the person brings money to the table, the lenders exchange money, that's when the title company gets paid. But meanwhile, there's a lot of overhead that has to be expensed in the meantime. So when my accountant and my bookkeeper noticed, like, hey, I noticed that your credit cards are high. Have you ever thought of getting a micro loan or using a loan that has low interest versus you spending this much a month on your interest? So the shocker was, hey, you paid this much in interest this month, times 12 is this amount. We shouldn't be spending this much money. And that's what your accountant and your bookkeeper is going to do, is going to analyze your books and tell you like, hey, you could be saving money here. So that's how my accountant ended up connecting me with Carol in hopes of me being able to increase my cash flow and reduce how much money I'm paying on my credit cards.
And so these were business credit cards. You had moved away from your personal credit cards, or were you kind of doing a mix of both?
So initially, the only credit card that I took personally was a Best Buy credit card. And in my mind and the way that I was using that card was that this was just for appliances that I needed for the business. Aside from that, it was all business credit, everything. Essentially, you're still a guarantor. You still have to put your personal information for these credit cards, but they won't be reported to the 3 credit bureaus under your personal credit. So I use things like a fleet card so that I can get gas for all of my transportations back and forth. I also was able to obtain an Amazon card for my office supplies. So those were some, and then from there I was able to qualify for another Amex card, which allowed me to put some of my vendor expenses. But as I said before, those vendor expenses start to increase when I'm not closing. So the income is not there, I'm relying on the credit cards, and those balances stay high until the income comes in. And that my bookkeeper was not happy with that.
So yeah, so there's basically, I mean, as we've sort of uncovered already, there's a few different paths to get a loan. There's, traditional banks, there's credit cards, which usually come from a bank, and then there's somebody like Pursuit, a community lender. Just talking about the bank route or the credit card route, Yaritza, what kind of underwriting did they do to extend you a credit line or a credit card? Was it all based on your personal credit history, or were they looking at the business financials at all?
I found that they were basing it on my personal finances. And those credit cards didn't really ask for my financials or my business plan. It was really based on what my personal credit was, I believe. I mean,
Okay, so you weren't turning in your historical business financial statements or anything like that.
no,
Okay.
not for the credit cards. No.
And what was the average that you were paying a month for the interest on the credit cards?
Oh man, honestly, the same amount that I'm paying monthly for my loan right now.
Yeah.
So, which is crazy because at least it's going back into money that I borrowed and not into interest. But I want to say a little less than $300 a month, depending on the balance.
Yeah, the difference there, just for everybody to understand, is Yuritsa was paying interest only for the most part on these credit cards, and the principal balance still stays there. Whereas if you go with more of like a term loan or micro loan from an institution like Pursuit or a bank, you're actually paying down interest, or you're paying down the principal plus interest
Much
every
more
month,
principal.
and she's saying that the payments were still the same, but you're actually chipping away at the debt as opposed to just leaving it there and allowing yourself to keep going by paying interest.
Exactly.
So Carol, just kicking it back to you real quick. You had mentioned you were in commercial lending and now work for a community lender. What would you say the primary difference is between a bank and a CDFI, especially on the, for the experience of the borrower?
Exactly. So banks, we all love banks, and we tell all of our clients that we want them to aspire to become a banking customer. Everybody has a banking relationship because, you need transactions. So transactionally, banks are the best. They have big back offices. So you want to with a bank. Full disclosure, Pursuit is funded by many of the banks. We receive capital from many of the banks. Some of the larger banks don't really have the capacity to work with small businesses. So grassroots, getting to know a business, it's just not their business model. But they have the most affordable programs once you can qualify for a bank loan. But there's this gap. So Pursuit was built to fill the gap after you start up, when you're growing, but you're not yet ready to get a loan from a bank. They're not ready for you. And what do we mean by that? Banks traditionally consider you a startup fully 3 years after operation. You have to reach a 3-year mark before you're considered a real company, which is unbelievable. We know definitionally startups for CDFIs, for any community lender, is as long as you're in revenue mode, the minute you open up your doors, you're a startup. And there are programs for you, lending programs for you. Banks do not. And then also, I feel like more on the credit side. So banks, or have regulation, whatever, their underwriting standards, usually, if your credit scores are not solidly in the 700s, preferably 800, you don't fit quite for a business loan. That is what traditionally I saw. Whereas a community lender, an SBA or a CDFI lender, we welcome, business owners whose credit scores are in the 600s, but solidly in the 600s. And I could elaborate, but you just it's not just about a number. We understand that your credit would be under pressure because you've just started a business. However, you want to be meticulous about paying on time, even minimum payments. So Yuritsa, good credit in that you may have high balances, but you want to make sure that you're making minimum payments. You want to make sure that you pay the tax man. That's a big thing, because a lot of our programs come from state and federal sources. So you want to be current on your payment of taxes. So those are two huge components that differentiate Pursuit and other lenders of our sort where banks can't help.
Okay. And you also mentioned underwriting. So, I mean, in general, underwriting is the process of approving a business or a person for a loan. Yuritsa, when you decided with your accountant that it would be a good idea to explore a loan from a community lender, what was that process like in applying, going through underwriting, actually getting the loan funded?
So I was connected with Carol, and it was sort of like an intake. Carol just asked me questions about the business, where was I financially? What would I be using these funds for? Those kind of preliminary questions so that she can get a gist I think it was so that she can decide what program may have been good for me, but also to try to just get to know me as a business owner and my needs. I believe we spoke on the phone. Then she sent me over an email, and it had a list of documents that were required. So that was fairly easy for me to provide. So I want to say I probably, within a week, I already had submitted everything to her. And that was mainly because as a business owner, I am fairly organized when it comes to my documentation. So I have a business plan. My business plan, I know exactly where it is. I keep my bank statements in a folder where I can easily assess them. The same thing with like reconciliations and all these other little things that the lenders may require. It's just about being organized. So I was able to just itemize and check off the list of what she needed. I emailed everything to her. I believe there was an application that I needed to fill out. It was like a 15-minute online application, not complicated at all. And then I waited for maybe like a week or so. And Carol was in touch with me during that time and telling me like, this is where we are. This is what you will be applying for. This is how you will receive your funds. And it was really fairly that simple. And then I believe from the start of my first conversation with Carol to the time that I received the funds was probably like 3 weeks, maybe less.
Okay.
Awesome.
And so at this point, you had about a year of operating history, right?
More.
Yes,
Your belt.
definitely more. Yeah, I
Oh,
had
more,
more.
okay.
Yeah.
And so in terms of the documents that they wanted to see, was it your P&L, your income statement?
Carol, do you want to give us
Yeah.
a quick rundown? But Herman, I know you have a question. As soon as we hear from Carol about what the requirements are, we'll grab your question. Just hang on for 1 second. Carol?
Sure. So not to put Yuritsa's memory on the spot. Yeah. So, but you did a great job. But in fact, 2 years of tax returns. Well, at least 1 full year of tax returns. So important, know where your tax return is and have access to it because you upload it.
Absolutely.
2 years of tax returns is preferable. And then to a point, Yuritsa was very organized. She had a great bookkeeper. So no matter what time of year, I forget what middle of the year that you applied for a loan, she could produce a profit and loss statement almost immediately. She knew she could press the button and it was fairly accurate. It was quite accurate. So those are the important issues. So have that handy. So that's it. 2 years of business tax returns, 2 years of personal. If it's, if it exists, a profit and loss statement, and then a list of any debt you have. So we knew what credit card she had, and that helped us judge, whether they would qualify for a loan. It was basically that simple. And if it took 3 weeks, that was just maybe a lot of back and forth. Maybe we were cleaning things up. We can usually fund within 1 week. Mm-hmm.
Okay. And this was for a microloan. Is that always backed by the SBA?
So,
Keisha, can you put yourself on mute, please? Sorry, we're getting some background noise. Thank you.
Sure.
Thank you.
So just for clarification, larger SBA loans, there's several programs. The names are confusing, but we do provide loans through the SBA where we get a guarantee from the SBA. So it's a longer process. We say give it a couple of weeks, 4 weeks. It could be longer for commercial property. But CDFIs, the beauty of it is we can lend 50,000, Pursuit can lend up to 100,000. It's not guaranteed by the SBA. So we don't have to go to them. We run our own rules. So basically we do our own underwriting and we can make those decisions very quickly. And that's the beauty of a CDFI when you have smaller needs. If you have a couple $1 million, for a big growth or acquisition, then you're going to go the SBA guaranteed route.
Okay. Herman, you've got a question for us.
Yeah. On the this is for Carol. Carol had mentioned that part of the loan application was your taxes that you paid, I think she mentioned. So I didn't know if that's in the formula, in the mix, to determine what a loan qualifies for, or if I qualify, or if I wanted a loan. And where do my taxes come into play? My personal taxes.
Yeah, that's a great question, Paul. I think, right, this is relevant for the
Yeah.
group, and it has to do with underwriting. We were going to get into that in a moment. So, there's several components. Some people say there's 5 C's to credit underwriting, but if we focus on the 4, the number one thing is the business. So I'm going to go straight to it. We're looking at the business tax return and the business profit and loss statement. So any lender, this is what I say, it doesn't matter if you're a bank, an SBA lender, or a CDFI lender. You need to have demonstrated that the business revenues after all expenses are paid, there's enough, and paying yourself, there's enough money left over to pay principal and interest on any loans you exist already, and then the loan we propose to make you. It's just a numbers, it's a numbers game. It's a numbers exercise. It's called cash flow, the cash flow to debt service. That has to be greater than 1. Okay, that's the thing. And that is the other issue about a bank. A bank requires a big margin, a cushion for error. So you need to earn $1.25. You have to have $1.25 of extra cash in order for them to get you a loan. Whereas an SBA lender and a community CDFI lender, CDFIs can almost work with 1-to-1. So if you're an existing business, you have to have demonstrated you have $1 left over, we'll make you a loan. That was what Yaritza's financials showed. If your projections, so Petra, when you build out your projections and, Pam and Paul's group is going to help you, your projection has to show you'll have money left over to pay the loan. Then Herman, your question, great one. So why are you looking at my tax returns? The tax return feeds into your credit score. We just want you to be a person with good credit, in good standing with your creditors, personal creditors. And when we look at your tax return to see how much money your household comes in, and our application has a few questions about your expenses. Do you have a mortgage or do you have rent, etc. The key where the two come together is if our underwriters see that your business looks quite profitable, lots of money left over, but you are not paying yourself enough money in ownership or distribution to pay your own, to live a good life and pay your bills, that's where we look at the two together. So sound complicated? I hope I made it as simple as possible. So we don't judge you on your personal, but if you're not paying yourself enough, we kind of know that, and your credit score will show it. And we're concerned about that.
Now, if I don't pay myself enough, for instance, and I have other income, for instance, Social Security, which is a good amount that covers all of my living expenses, my mortgage, and heat, regular bills. So, does that hurt me or help me because I have steady Social Security, the government every month?
Yeah, that's a good understanding. No, that is very helpful. The SBA, we do not require that you have outside income, but in that case, we require that the business you're in, the new business, supports you. If you have outside income, household income, that's okay. It rolls into a decent personal credit score. We're okay with that. So the side business, not side business, but the new business you're in, you don't need that kind of distributions or salary. We're really that part is okay. Good question.
And then
what it really sounds like, Carol, is that if somebody's starting a business and they're pouring all their money into their business and they're not paying themselves, or they're not making enough to live for themselves, then the chance that the business is going to survive is super low, right? So that's sort of the big picture on this, right, Carol, as far as when you look at the big picture on this?
It really is. And what it happens, and that's why we're all here. We don't want to see that. And so if we turn down a loan for that, there's part of us saying we're kind of doing you a favor, or we're giving you a heads up that this will destroy your own personal credit score, and that snowballs. So then your credit score is low because you put a lot of your own money in, but you're not getting enough back. Now lenders won't speak to you because, let's say, community lenders, again, in the 600s where you're keeping current is fine. When your credit score dips below 500, we send you out for credit repair. We have great services to help you, but it's a catch-22. And we don't want to fund a business that is ultimately going to sink you personally. That would be awful for everybody. And I know Pam and Paul feel that way when they advise businesses. Mhm.
Are there two different scores? Is there a personal score, credit score, and a business credit score, or are they both one and the same?
They are two. I'm not an expert, but we've done a lot of work on this. So for very small businesses, personal credit score is sort of the one we look for. Most of our applicants in the small business arena, we don't see a business credit score, or if we do, it's very low. Paul, you could chime in. You know, we come out of commercial banking. If you go to a bank, they're going to try to get your business credit score. So ultimately, years ago, that is, years from now, that is important. But most community lenders and even some SBA lenders don't usually, we'd be surprised if you had a strong business credit score. You're almost too small for it. So do a little research. We have different feelings. We don't actually need it or require it in our On Pursuit's business application.
Yeah, I think if you zoom out and look at who is the clientele of a CDFI versus a bank, generally speaking, the CDFI is dealing with earlier stage companies that are just not going to have as extensive a history of business credit. So yeah, it's relying upon other factors, which I think is what makes a CDFI so great, is that they're willing to get creative and look at some of the details as opposed to just taking a blunt approach to your business and saying, oh, they don't qualify based on these various metrics.
Can I ask a quick question?
Yeah.
I wasn't sure, Carol, you went through a brief list of what you require and what you guys look at. Is a business plan part of it? Because I know Yuritsa mentioned it, but then that didn't end up on your list. So I wanted to understand that.
Yeah, good question. So we did not require it for, if you've been in business a year or so, at least 1 year of tax return. We don't require it. If you want to help the underwriter understand, then you can send us an executive summary. Okay, and we don't require projections. So we did not for Yuritsa. We did not require any of that. However, for the startup people, right, a business plan, a well-written business plan, and then 2 years of projections. So, right, when we put in for an SBA guaranteed loan for a startup, 2 years of projection, first year, month by month, and then a second year, and then a business plan that, in my opinion, is the narrative for the numbers. Because remember that at the end of the day, we're going to look at the numbers. You may have the best written business plan and we just love the product. I'm in love with your product. If the number doesn't show that you have enough cash, free cash, to pay debt, you're still not going to get the loan. So something, we have to tweak it. And that's, and Pam and Paul know that that's ultimately the key.
Yeah, that's a great point, that they do have to work together. And they really need to support each other. So you're writing about what you're doing, and then that's being reflected in numbers. And if you don't have people in your life, if you're not a person who puts together numbers in a spreadsheet really easily, there are lots of organizations out there that can help you. You can even go on things like Upwork or Fiverr and find somebody to put together a quick projections for financial model for you. Peter, you raised your hand. Do you have a question? Oh, hold on.
Sorry, yes, my mic was off. Sorry. I have several questions, but I'm not going to ask all several. First, let me ask, Paula or Pam, are you free after the meeting? I have a couple of questions about the startup.
We can set some time for sure. Yeah.
Okay. One question. Do you guys recommend that you have, I'm answering my question at the same time. Do you recommend that there is financing, loans, business lines of credit, credit card, cash credit cards, or before you get started, so that way you don't go into opening doors underfunded.
Yeah, it's a good question. I mean, I think that most lending institutions want to see a little bit of skin in the game. So you're putting in some of your own cash, maybe you're borrowing what you can't cover. But it is a good question that some entrepreneurs go into things and they just have to very slowly and incrementally make progress, and that might take honestly years, whereas they could go secure a loan or raise some money from friends and family, or acquire capital in a different way that actually allows them to go much faster. Obviously the risk there is that you don't get the thing off the ground, you don't start generating revenue, and then you're stuck holding the bag for a bunch of money that you owe. So I think that my advice here would be really put together a plan, orchestrate all the pieces as best as possible so that when you do get some sort of funding, you can just turn the switch on all of them and they start to come together and generate revenue. Because if you just go out and say, I'm going to get a loan for $40,000, and then I'll start putting in the research and the work to really figure out how I would use that money productively, you're bound to fail, because you're just going to waste a lot of time
Right.
while you're having to repay this loan. So I would say put together all the pieces up until the point that you can't, up until the point where money is the thing that will then allow you to flip the switch to make the thing start to come together and hum.
Yuritsa, do you want to give us a little input on, you had been working more on the corporate side, and then you just decided to start on your own. How did that look for you getting started?
Scary. It's really, I mean, in full transparency, it was the first time that I had ever been unemployed. So I really didn't know what to do. I was fortunate enough to tap into some connections that I made while I was working in the corporate world. And I reached out to some underwriters, which is who I work with in my industry as an insurance company. And I told them, like, hey, do you know anyone who's looking for like independent people or like people to work remote? Because at the time I had a kindergartner, and that transition in the summer of 2020 was a little scary. So I ended up, between my husband and I, ended up taking some money from retirement, and so that we can open the required bank accounts that the company needs. And you can't open a bank account without any money. So that was where those withdrawals came in. So it was an investment from my husband, really. And I started working independently for another title company, and that was what secured my income for the first year until I was able to generate enough for myself and really make the right decision on who I wanted to be appointed with as an underwriter. So from 2020, mid 2020 to about September of 21, I was working independently with my established company, but working as like an independent vendor or an independent contractor with other industries. And then once I was appointed and fully established and able to provide policies through my own company, by that point, I already had those few credit cards, and I was making enough generated money that I didn't have to put more money into the business personally. I was able to feed off of what I was making because I set it up to where the company was making money from the independent contracting that I was doing. So that's kind of how that looked for a little bit until I was able to really grow organically, have more closings, and get out of my house and rent an office and hire employees. And that's where I am now in the stage of growing more and more organically and unable to pay myself, which is nice.
Yeah.
I think that's important I think what I'm hearing there from sort of a framework perspective is you identified a way to keep keep your income up, while also finding these partnerships that you can plug into that start to like lay the foundation of your own business. Mm-hmm. And then at some point you transitioned away from maybe this income source to this income source, as
Exactly.
opposed to saying like overnight, I risked it all and sweated for months and whatever, and just trying to get a new income source coming along.
Exactly.
Yeah, so that's a way better calculated risk that you took as opposed to just betting it all.
Yeah.
If you don't mind, I had
Oh, yeah.
two thoughts on that. Yeah. So Eureka, that was a great roadwork. Because of the nature of the business that Eureka is in, she was able to do that. I will say when it comes to opening brick and mortar, right? Like the number one mistake I see is that somebody has started it. So with brick and mortar, you're either all in or you're not. You can't make it happen. And but still, a lot of people are afraid to take on. You think, how can I apply for a loan? There's no way. I don't even have a business yet. There is an SBA program for it, and Pursuit is expert at it. And we want to be there from the beginning, before you sign leases, before you do any of that. You work with, Pam's group, or you work with a small business development centers group for the whole plan. But the plan will say, it's going to cost me $100,000 to launch, whatever. And I have $20,000 to put in, and you'll be able to prove that. And I am asking you, Pursuit, for 80. And that 80 is involved, is from equipment, from leasehold, from soft cost, you're itemizing everything. And we can analyze that and give you feedback and the projections. And that is the perfect application for a startup loan from an SBA. The imperfect one is trying it on your own, thinking that it'll only cost you about 30 to launch, and your 30 hasn't even gotten you halfway there. Then you come to Pursuit or an SBA lender. Extremely difficult. For Herman's business, it could be different. If he's ordering, it's not brick and mortar. If he's just ordering equipment, delivering things like that, that could be launched, with his own funding or not. That's something we work with. But the starting up of brick and mortars, the best is to come with the full plan. And then one thing, because I don't want to run out of time, when we were talking about the importance of projections and helping, whether it's to get the loan or after the loan. Eureka, would you mind sharing the other benefit, which I did not discuss? When you work with a CDFI community lender, you get paid, you get pro bono services, paid consulting services. And just explain a little bit what you're doing with our consultants right now.
So currently I'm working with a consultant through Pursuit, which I had no idea about Pursuit. So I was already 3 full years into business and had no idea about these services. So I definitely love that this is being put out there for new businesses and new owners. So currently I believe she's an independent contractor with Pursuit. She is helping me with my financial projections. So I'm working with her. She is helping me do, I believe, a 2 to 3 year projection based on my goals, based on how my business has flowed over the last 2 years. And I've been working with her probably for about a month now, where she's asking me questions and we're really jotting down everything and trying to meet our goals. I told her how much I wanted to make based on what I made last year. And all of this is free because I took a loan with Pursuit. So super cool.
And that is part of SBA funding. So Pursuit receives, so the SBA is supporting small businesses. They do it by doing loan guarantees, sometimes by funding, but then they also fund CDFIs. They give us money to continue supporting a loan client throughout the life of their business. So their loan could be paid off, long time paid off, and Eureka will be a Pursuit client. And she can call us and be like, I need a new website. I need a marketing strategy. And we do all that. So that is federal tax dollars at work for small business.
Yeah, that's an amazing benefit. So what I'm hearing is there's actually programs or work or assistance that can happen before the loan, and services and assistance and consulting that can happen after the loan when you go to a community lender, which maybe we don't all know this, but that's very different from the way a bank works. You know, I think with a community lender, it's more like there's an agency involved there, you know, that's providing services on top of the cash that's coming in to help you grow or launch. So that's, yeah, it's kind of amazing. And I'm always stunned that more people don't know about a CDFI, because it really is, you know, it's a very valuable resource for an early stage entrepreneur.
Absolutely.
Yeah.
Herman, did you have a question?
Yeah, is Pursuit a brick and mortar, or is it a internet based?
We are actually, yeah, we're old school. We have our headquarters are in Albany, New York. That's where we started 65 plus years ago. Now we have offices throughout New York State. We have 2 in Jersey, 2 in Pennsylvania, 1 in Connecticut. Yeah, so we have virtual offices, or we have remote, you know, we have remote workers, but we have a big New York City, Long Island office. I'm in Mount Kisco. Yeah, we're real people, real offices. So
Good to know.
Question, I'm at the stage of right now deciding what bank I want to go and do business with. I've been with Hudson Valley Federal Credit Union forever as a
Okay.
personal, and honestly, that's how I have financed my jobs. Is, you know, I have a Hudson Valley Visa credit card, you know, with a 30,000 limit or whatever it is, and that's how I buy equipment, and you know, and I install it and then make a profit. But you know, that was a personal credit card, and it's not a business credit card, and that's where I'm transitioning right now, because I've been doing a DBA, a legitimate DBA on the books for 3 years now. And is that my question on that is that a positive toward the loan to have the DBA? And then I just transitioned a couple weeks ago into a LLC, you know, with my IEN number and you know, all the insurances. Does that help towards does that go to give a positive towards a loan, you know, having a DBA, you know, prior to an LLC?
That's a good question. It's as long as we finance sole proprietorship. So as long as you have a separate set of books, we prefer that you are, you know, that you establish a DBA, like at minimum. So on a Schedule C, you know, at the top of the Schedule C, the business has a name that's somewhat separate. When you move from a DBA to an LLC, for us, there's no difference in terms of the qualifications, you know, the underwriting. It's not more rigorous. It's not easier, or it's the numbers are the numbers. As long as we feel that the numbers on a Schedule C are accurate, you know, you sent it to an accountant. If you're doing your own taxes, you know, then, you know, we're going to look a little bit harder for Schedule C, but so it builds credibility, but it's all about how the numbers make sense to us and that they weren't pulled out of a hat or something like that. But LLC is the way to go. You know, that makes sense. You could operate quite a while as a DBA, though you wouldn't be biased against that.
So does it make sense for me to jump ship from my bank, which is Hudson Valley, and tag along and get on with Pursuit?
No, actually,
That's where I'm at right now.
right. To be
I don't know what to do.
Yeah, to be very clear, Scott. So Pursuit does not have a back office. We are a non-bank. We don't take deposits. So you always want to have, we encourage you to have a banking relationship and a credit union. We're very fond of credit unions for small businesses. I'm actually very fond of Hudson Valley, just a shout out there. And we've helped a lot of their clients. If they aren't able to do the loan, we can do the loan, but they're great relationship people. That's, you know, my view. Whoever you feel comfortable with, just note that, you know, the larger the bank, the less time they will spend on your relationship, you know, as a small business owner. Just saying. But
So Carol, just because you can have a bank relationship, that doesn't preclude you from working with Pursuit on a microloan.
correct. That's always, it's almost always the case, right? That
Thank
you
you.
have to have a bank. Sure. Mhm.
Okay.
I want to get back to Yuritsa real quick. So when you secured the loan, you know, they funded it, what impact did that have on your business? I mean, was it something that you could measurably tell on a monthly basis, or I guess talk us through that?
So what it immediately did for me was open up cash flow. So I was able to, essentially, I used all of the funds to pay down my credit cards at the time. I was in a position where I was putting a lot on the credit card and I wasn't obtaining the income quick enough to pay it down monthly, which is what my accountant suggests, right? You want to pay down your credit card to a zero every month, avoid the interest. I was not in that position because the income wasn't coming in fast enough. So it immediately freed me up to have that available credit on those credit cards and then give time for my income to start increasing. So that's really where it helped mostly, because it saved me money on the interest. And then it freed up that income so that when I did find myself again in a position like, oh, the income isn't coming as fast, now I have that available credit again. So that was really what it was. And the financial projections now is going to help me scale that more and be more aware of how I am using my credit.
Right. I think the challenge, yes. So you still have the challenge of managing monthly cash flow, which is, for a title company is difficult. So to put you in touch and, with other experts, consultants to help you manage and not just be like, good luck with that. That's the important thing, because it is difficult, and to have an expert, access to an expert to help you think through it and what best practices. I think, hopefully that will really pay off in the long run. Mm-hmm.
Yeah. One of the first things I do when I start working with a company is try and model out what do the next couple of years look like, because so many times entrepreneurs get very surprised by the fact that they have no money all of a sudden, when it's like you could literally just type these things into a spreadsheet, do a couple of simple calculations and show yourself, you anticipate you're going to bring in this much money. You have these fixed expenses. It costs you this much money to make that much money. What does that look like after 6 months, 9 months, 18 months, 2 years? It's not a very difficult exercise, but I think honestly, sometimes it's more of a, I don't want to look in the mirror kind of thing. An entrepreneur doesn't want to see how bad it might look in the future. But I think you just have to kind of get used to that and say, I'm going to be proactive about this and figure out how to navigate the gaps in cash flow if they exist, or, how I'm going to invest the money that I'm bringing in if there's a positive cash flow that exists after a number of periods.
Right.
Exactly.
And then
also get into talking about money, right? I think that even as business owners, we can get into it, but we don't have that personal experience of talking about intake and budget and projections. We don't think like that a lot of times, and we don't have that experience.
Yeah. And then Paul, just to paint it even more in a positive way, and it could be, let's say for Herman, that like 3 years out, a growth company, you could be successful and your sales, your top line is actually growing, in a very rapid manner, but you're underfunded can do in a company. So not just that the numbers prove that you really lose money on every sale, just the opposite, but you take on more business, then you have the capacity for working capital. That's that chunk of money that needs to stay in the business. You will self-fund. Eventually, if you keep the profits in your business, you become your own bank and you don't need it. But most ones you would aspire to get a line of credit with a bank eventually, Yaritza or Herman, so that you can do that. Until such time, you need a bank, you need a funder to help even in the best of situations, in the growth situations. And it has been the undoing of successful companies that they didn't have that safety net. So
yeah, that's a very good point. And yeah, I mean, you mentioned that you eventually want to become your own bank. And we talked about that a little bit last time on self-funding and using customer growth as a way to fund your own business. But there are some businesses that inherently do better utilizing some sort of debt. If you're producing, physical goods, sometimes you just want to fund inventory on debt and have do it at a low interest rate. There's definitely times where debt can play in and really play to your advantage. Any other questions from Herman or Petra on this topic.
For me, yes, I'm at a tipping point right now. So should I keep self-funding? Because that's what I've been doing forever. Never took a loan. Or should I make the move to have some, money in a loan to use? I could use some right now because there's some software I want to buy, and I'm like, oh my God, I more money I have to spend, and
Yeah, after Herman and Petra, if you guys want to stay on for a minute when we wrap up, we can talk to you about a little bit about next steps. It's 12 o'clock. I want to take this time, and Paul and I both, to thank you so much, Carol, for joining us. And Yuritsa,
Thank you.
congratulations on doing an amazing job growing your business. We wish you the best of luck. We're having our last session next Tuesday at 11 o'clock. So hopefully you guys will join us again. And we wish you a great day. So with that, we'll turn off the recording.
Thank you.
Carol and Yuritsa, thank you. Guys can drop off whenever you want. And Carol, if you want to put up your